Everyone is talking about JEPQ as it promises high monthly dividends and is backed by some of the biggest tech stocks in the world. While everyone is focused on how much money they can make, almost no one is talking about the risks that come with it. JEPQ isn't just a cash machine. It comes with serious trade-offs that could limit your gains. If you're already invested in JEPQ or considering adding it to your portfolio, then this video is for you. Make sure you watch this video till the end because today we're pulling back the curtain on JEPQ, JPMorgan Nasdaq Equity Premium Income ETF, and exposing the risks that no one talks about and showing you how to avoid them or minimize their impact on your portfolio. Before we talk about the risks, let's quickly explain what JEPQ actually does. JEPQ is an income-focused ETF that invests in the Nasdaq 100, home to major tech giants like Apple, Microsoft, and Tesla. What makes JEPQ different from regular ETFs like QQ is that it sells covered calls on a portion of its portfolio to generate income. This strategy allows JEPQ to pay investors high monthly dividends. As of 2025, JEPQ has an annual dividend yield of around 9.49%. which means for every $10,000 invested, you could earn about $949 per year in passive income. Sounds great, right? But this high income comes with some serious trade-offs. Number one is limited upside potential. Let's break it down in simple terms. JEPQ sells call options on its holdings, which means that when a stock like Microsoft or Nvidia goes up too much, too fast, JEPQ doesn't get to fully benefit from that growth. So if the Nasdaq has a massive rally, investors in JEPQ won't see the same level of gains that a regular index fund like QQQ would get. For example, in 2023, the Nasdaq 100 skyrocketed by over 50%, but JEPQ's total return was much lower because of its covered call strategy. Investors who were expecting massive capital appreciation were left disappointed. Number two is high market volatility. JEPQ invests in Nasdaq 100 stocks, which are known for their high volatility. Tech stocks like Tesla, Amazon, and Meta can swing 10 to 15% in a single month. Because of this, JEPQ's net asset value, NAV, can drop significantly when the tech sector is struggling. For example, during the 2022 tech sell-off, the Nasdaq fell over 30% and JEPQ also took a major hit. This means if you're holding JEPQ during a bear market, your portfolio could experience significant losses. If you're looking for stability, JEPQ might not be the safest option. Unlike dividend stocks or bonds, JEPQ is still tied to the performance of highly volatile tech companies. Number three is unpredictable dividend payments. One of the biggest reasons investors flock to JEPQ is its high monthly dividends. But here's something most people don't realize. Unlike traditional dividend stocks that pay a fixed amount, JEPQ's dividends change every month based on how much money it makes from selling options. Some months you could get a big payout, while in others, the dividend could drop significantly. For example, JEPQ's January 2024 dividend was $0.46 per share, but by June 2024, the payout had dropped to $0.34 per share, a decrease of 26%. If you're depending on steady, predictable income, especially for retirement, JEPQ might not be the best choice. Number four is tax consequences. JEPQ's high dividends sound great until tax season rolls around. Unlike normal dividends, JEPQ's distributions include short-term capital gains, which are taxed at higher rates than qualified dividends. If you're in a high tax bracket, you could be paying 30% or more in taxes on your JEPQ dividends. If you're planning to invest in JEPQ, consider holding it in a tax-advantaged account like an IRA to reduce your tax burden. Number five is potential net asset value erosion. High-yield funds like JEPQ pay out a lot of their income. But if the fund isn't growing, the net asset value could slowly decline over time. This means that while you're getting dividends, your principal investment could be shrinking. Investors on Reddit's dividend investing forum have raised concerns that JEPQ's NAV hasn't been growing as fast as the Nasdaq, suggesting that the covered call strategy may be limiting long-term growth. So, Is JEPQ a bad investment? No, but it's definitely not for everyone. JEPQ might be a good fit if you're looking for high monthly income, you don't mind limited upside potential, you understand and accept the volatility risks. JEPQ might not be a good fit. If you want maximum growth potential, you need stable, predictable dividends, you're in a high tax bracket and want tax-efficient income. If you're considering JEPQ, make sure it fits your long-term strategy and not just because of the high yield. Always diversify and avoid putting all your money in one high-yield ETF. Now that you know the risks of JEPQ, what do you think? Are you still investing in it or are you reconsidering? Let me know in the comments. If you found this video helpful, hit that like button and subscribe for more investing insights, and I'll see you in the next video.